Hello everyone, this is Mark with Semantics Research with your market recap. So today we had a pretty uneventful day with not much movement in equities. The yield moved a bit higher, while the dollar and the euro traded sideways and VIX had a bit of a contraction. We had the 10-year Treasury yields rise to 3.04% and the 3-month Treasury yields rise to the highest of the year at 1.16%. At the start of the year, 3-month Treasury yields were 0.05%, a 2,088% increase year to date. 10-year yield Treasury yields were 1.63% to start the year. So we had Treasury yields continue to rise all year long, especially short-term yields, causing inversions and flattening of the yield curves at all maturities. The reason for this is that the inflation is at 40-year highs, and the bond yields are too low for investors, especially in the short term, which makes them a very unattractive investment. And you have the Fed that is not really raising rates enough to make inflation go down. So the market interest rates are doing most of the heavy lifting for them. This currently is making and will continue to make bond and stock prices to go down, as well as making the cost of equity go up, which is making the discount rate go up for all companies, as well as a higher equity risk premium, which is making company valuations go down across the board. This affects risky companies more than stable companies, since they are more volatile and the cost of debt is amplified more with the worse credit ratings, increasing their discount rates and reducing their valuation. In the current macro environment, the Fed is behind on the inflation curve, and it is likely to see money continue rotating into stable equities and safe assets such as the dollar. The risky equities in energy and material sectors may continue to rise throughout the year and longer due to energy and commodity supply chain disruptions and sanctions on Russia. We have seen the energy and material sectors leading in earnings per share for 2022 so far, and these are very cyclical and high-risk sectors traditionally. Other than those, the consumer staples sector is doing pretty well at the start of the year, but recently went down to its low of the year, but is now starting to climb back up to where it was before. We had money going into consumer staples as it is a sector that is very stable in growth and is very generally good for preserving capital. But we had Walmart and Costco coming out with lower guidance, lower than what many investors were expecting, which made the sectors go down. The utility sector has been the second best performing sector this year, as it is another stable defensive sector like consumer staples, but it is doing much better this year as it is connected to the energy sector. The healthcare sector is the fifth best performing sector, as it is also a defensive sector, other than pharmaceuticals and biotechnology being very high risk. Then the sixth best performing sector this year is industrials, which is a defensive sector as well, but to a much lesser extent. It is generally the fourth best performing sector in an economic slowdown. You do see financials and real estate both down 10% and 15% respectively year to date, and financials and real estate are both sectors that are very cyclical and highly sensitive to the economy, as they are basically the backbone of the economy. Then the highest growth and highest risk sectors have been performing the worst this year, as interest rates have been skyrocketing and the demand and supply are coming down. We have technology, communications, and consumer discretionary sectors reporting the worst earnings per share of the year, as well as being down more than 20% on average year to date. In the first quarter of 2022, we had energy sectors leading in earnings growth, followed by the materials sector, They are both high yield sectors that continue to perform as well as commodity prices continuing to soar. We also had energy and material sectors leading in revenue growth for the first quarter of 2022. In terms of more stable and defensive equities, we had the industrial sector being the third best performer in earnings, while revenues below the market overall on average. The utility sector followed industrials in earnings, but had the lowest revenue growth, which is still very impressive for the sector, as it is usually some of the lowest growth in earnings, historically speaking. Pretty interesting events are coming in the next 2 weeks with the CPI this Friday and the FOMC on the 15th. It appears to be that 4200 on the ES seems to be a very key technical resistance, with no volume being traded much higher as we approach that level, as most of the volume is actually in the lower end of the range. We may see a big movement in the market after a significant June options expiration, which is around the FOMC date. And we do have the second quarter GDP around the corner as well in a few weeks. The second quarter GDP, the GDP now data, has been dropping rapidly by about 0.5% increments, which also does not factor in COVID and other key factors. So this does not seem rather too good, as the real number might be much worse. Today we opened above 1% on the ES, and we failed to rally higher, and we ended up down in the day only up about 1/3 of a percentage, which is a big fail of a rally if you ask me. The VIX is currently in an area where it makes options moderately priced, where it's not too cheap but not too expensive, and I do think generally volatility would be elevated for a certain amount of time, as long as we continue having certain market headwinds throughout this year. If we take a look at today, we had green energy stocks surprisingly catch a heavy bid when Biden announced plans to make the solar industry ramp up productions with the Defense Production Act that he announced today. We also have the Fed rate hike expectations having dropped a bit, which is leaning towards 50 basis points in September after the Jackson Hole Symposium in August. If the CPI on Friday comes in hotter than expected, and it will likely cause the dollar to catch a bid, and we rather have bearish sell pressure for most equities. And it appears that a lot of retail traders are buying Amazon into the stock split, thinking this is a bullish signal, which is not necessarily true. As in the past, it only tends to be correlated to positive returns in a low rates environment. And sometimes when you have retail traders buying out of the money calls en masse and causing a gamma squeeze. But in this case, if you're a retail trader, I would urge caution, as macroeconomic factors seem to matter more in this case, and we're not really in a part of a business cycle to bet heavily on this, because you see liquidity being sucked out. And that is it for today's daily report. Thank you all for watching, and be sure to check out the links in the description for more updates. Thanks again.